Welcome to Gold Silver Pros.
Hey everybody, this is Rob Kientz of 𝙂𝙊𝙇𝘿. This is your weekly market update. I'm recording it on September 23rd, 2022. It will be out in a couple of days for your preview for the next week. As for what happened this week in economic news, we had several negative-leaning economic indicators reflecting the consumer end of the market, and that's what we're going to focus on today. Looking at building permits and housing starts information, which came out this past September 20th on Tuesday. We're down on both. We had 1.52 million building permits on expectations of 1.62, and last month we had 1.69 million, so building permits are down. On housing starts, we had 1.58 million on expectations of 1.5, and previous periods 1.4. So we do have some new housing starts, but overall the building permits have fallen. Existing home sales came slightly under what it did last month at 4.8 million, but it was higher than expectations at 4.68. Initial jobless claims rose in the economy from 208,000 the last month to 213,000. Continuing jobless claims fell from last month at 1.4 million to 1.38 million. Our current account deficit is negative 4% as a percentage of GDP, and leading economic indicators, a broad index looking at the market, were negative at 0.3%. S&P U.S. manufacturing PMI was slightly above at 51.8 on expectations of 51.5, and U.S. services PMI was up from expectations of 46. The actual print was 49.2. Next week, we have a lot of information coming out that we'll want to follow again concerning the health of the economy and consumers. We've got durable goods orders and core capital goods orders that'll tell us what people are buying. The Schiller U.S. Home Price Index, which will be very big. We'll see if the real estate, especially for homes in the United States, is continuing to fall or if it's going to stabilize. Consumer Confidence Index, new home sales, initial jobless claims, continuing jobless claims. And then we'll have information on inflation with the PEC and the core price indexes, along with data on real and consumer spending. In the markets today, as of 11:42 a.m. on September 23rd, 2002, the Dow has tumbled 600 points, and a lot of things are falling off as recession fears increase. Of course, we had the big news this week was the Fed announcing a 0.75% or a 75 basis point hike in the federal funds rate. And Powell also mentioned that they're going to try to get the federal funds rate up to 4.4% next year, possibly this year if they can be aggressive enough. And that's higher than the original target. Last year, they were talking about getting it up to 1.8%. And then beginning of this year and in spring, they talked about 3.8%. Now it's 4.4%. So I believe the Fed believes that they can tighten more before the economy goes into a severe recession. But I also think the economy has already started the recession, so it's going to be a flight. It's going to be a quick thing. Can they get the interest rates up in time to offset the recession, which is basically raging now, as we're going to talk about today? The U.S. markets are down all over the place for the first time since, I believe, 2007, dating back to prior to the last financial crisis. We have a 4% interest rate on the 2-year Treasury bond. The 2 and 10-year are the bonds that most people watch in the U.S. because the 10-year is the standard for long-term debt and the 2-year is the standard for short-term debt. And when those invert, meaning the 2-year commands a higher interest rate than the 10-year, is said to be the most consistent leading indicator of an oncoming recession ever. And it tends to play into the narrative that we are in a recession. The 2-year is now at 4.167%, the 10-year 3.687%, about a half a point difference. And it's been inverted for a while. So I would say that that does indicate that we are in a recession. Cryptocurrencies are down as well. Right now, Bitcoin is trading down 647 points to 19,333. That's a percentage change of 3.3%. Looking at some of the other ones, Bitcoin Cash is down 2.57%. You have Ethereum down 2.76%, Litecoin down 2.75%, XRP down 1.83%. So the crypto complex is also experiencing a sell-off. Everything is selling off right now. If we go into gold and silver, looking at 11:44 a.m. on September 23rd, 2022, gold is sold off $27, down 1.59%. It recovered after selling off from about 2 to 6 a.m. in the overnight markets. Silver is also down 4.16%, bigger percentage decline, down 82 cents to 18.85. Silver continues to fall on broad selling on the futures markets. We'll get into explaining that here in a moment. A couple of big stories this week. We already told you about the Fed and their interest rate decision, which will affect everything. We also have more on inflation. A story by Catabella Roberts via the Epic Times. Inflation costing the average American family $11,500 this year. That's more than previously. Americans are set to fork out an extra $11,500 this year if they want to enjoy the same standard of living they maintained in 2020, according to new estimates from NerdWallet. Those of you who follow NerdWallet know that it tracks a lot of economic data, and it's one of those places where people can go to if they want to learn how to save on their personal finances, get good deals on credit cards and loans and things like that. So they publish a lot of information. The estimates from NerdWallet published in August were based on inflation and annual spending data from the U.S. Bureau of Labor Statistics. Analysts at NerdWallet looked at how spending would compare this year to 2020 when the COVID-19 pandemic began. Analysts said 2020 was the last full year when inflation was relatively stable. In that same year, the U.S. inflation rate was 1.23%, according to the government. As of August of this year, inflation in the United States stands at 8.3%, according to data from the Bureau of Labor Statistics. A quote from NerdWallet. In all of 2020, American households spent $61,300 on average, according to analysts. This number includes everything we spend our money on: housing, food, entertainment, clothing, transportation, and everything else. In 2022, it stands to reach $72,900, a difference of more than $11,500 if consumers want to maintain the same standard of living. NerdWallet analysts said this is an average estimate and therefore one that is exact to a very few. Those who earn and therefore spend more will see more dramatic dollar increases. Those who earn less may see less dramatic dollar jumps, but the impact of these rising prices could be more significantly felt. In other words, if we did all the same things, we would pay $11,500 more in 2022 than we did in 2020. And that means that people are going to have to make decisions about what they spend their money on if they don't have that extra $11,000. I know that I don't really want to spend that if I don't have to. A lot of you guys don't as well. More news on FedEx. Last week, I announced that FedEx had said that they believe there's going to be a worldwide recession due to shipping rates, and that they do shipping for most of the economy, and it would be a leading indicator. Now FedEx is back in the news this week, announcing the largest general rate increase for their products in history. It says here, FedEx Corp announced, and this is from FreightWaves, it's announced late Thursday a 6.9% general rate increase for 2023, the largest year-over-year increase in its history. The increase will apply to all FedEx services, except for its less than truckload service, FedEx Freight. Increases there will range between 6.9 and 7.9%, depending on the customer's transportation rate scale, the company said. Typically, FedEx raises its annual tariff rates between 4.9 and 5.9%. Analysts were expecting 6%. It's a lot higher than that. So again, FedEx still seeing issues globally with business slowing down, therefore having to raise its rates also due to cost pressures. Another piece of news, Goldman throws in the towel. This is from Zero Hedge. It slashes the S&P price target to 3,600, warns of a recession crash in the S&P to 3,150. According to the article, less than a week after Goldman slashed its 2022 GDP forecast to stagnation, i.e. 0% growth, hinting that a recession was on deck. And just 2 days after, it reported that Goldman's chief equity strategist, David Kostin, launched a trial balloon, telling clients that even as he still has a 4,300 year-end price target in the S&P 500, he saw a broad index tumbling as low as 2,900 in a recession. When we commented that, and the article goes on to talk about it. So it looks like some of the banks are beginning to predict recession. We had in our live stream, I think, a few weeks ago, how Bank of America predicted recession 2023. And if you look at what the Fed's doing, trying to get interest rates to 4.4% as their end target, either by the end of 2022 or about the middle of 2023, that would seem to coincide with what the rest of the banks are saying and their analysts are saying is a recession. So we think of a recession now, but we think that it's formally going to be recognized either later this year or next year, at which point the Fed could start running off interest rates and going back to quantitative easing if it's able to get to its 4.4%. So if you read between the lines and look at what's going on, holistically, everybody expects the Fed to pivot course sometime in the beginning or middle of next year. We'll continue to follow that and see if that's what actually happens. Lastly, on the news, the Bank of England hikes rates 50 basis points in a split soft decision, confirms QT gilt selling imminent. They raised half a percentage point, the Bank of England did, on the heels of the Swiss Riksbank raising their rates by a full percentage point earlier this week to combat inflation. A lot going on there. We're going to move over really quickly to the gold and silver report, and we'll get that up on screen for you guys really quickly. As you can see here, we're on the CME group looking at silver. If we look at volume and open interest, we have had a nice little spike in silver pretty regularly, about twice a month dating back to August. August 26th, we had a bump up in volume and open interest, September 6th, September 12th and 13th, and September 21 and 23rd. These raises in the open interest have to do with additional short selling, which also coincides when prices fall. It's very simple to see how this market works. You have people go long and people that go short. If there's more sellers in a market than buyers, the price goes down. If there are more buyers than sellers, it goes up. And this is just futures trade. It has about 99.9% of it has nothing to do with physical, but this is how spot prices determine. As of Thursday, September 22nd's data, yesterday's data, we saw a rise in silver about 14 cents on the predominant contract. You can see right here, the overall net change was about 13.7 cents. If we look at Wednesday's data, it was down 30 cents on the predominant contract. If we go and look at Tuesday's data, it was down 17 cents on the predominant contract. And if we look at Monday, it was down 23 cents. So there's been tremendous selling pressure, although slight upward pressure yesterday being offset with selling today. So currently we're at 1883. If we go back and look at the volume and open interest and see how many deliveries there were from the EFP perspective, exchange for physical, there were 550. That goes through the London market. And if you look at deliveries, there are only 107 delivery on the September contract. Not a whole lot of deliveries for silver. We want to go over and look at gold. So I'm going to do CME Group Gold. And we're going to do the same thing and tell you exactly what's going on with the volume and open interest in the gold market. So as we look at it, gold seems to be, has selling pressure, but we don't see quite the amount of volume and open interest spikes that we saw in silver. Certainly there have been somewhere around September 15th and 16th, and then 21 and 22nd that are higher than normal. You can see on the chart. And if you go and look at the settlements, was that buying or selling pressure? Well, looking at Thursday, we had buying pressure up $5. So yesterday, both the metals were up. But if we look prior to that on Wednesday, it was up $4.08. Sorry, as I work with this website, it's very picky about how you move your mouse. We were down as of Tuesday's data, down $7. And if we look at Monday's data, we were down about $5. And if we look at Friday's data, we were up about $6. So net gold's been about the same from last Friday to this Thursday, but huge selling pressure today, down $27. And again, if you look at the volume and open interest, whenever gold and silver are down, you see a spike in open interest. That's selling pressure. More sellers come into the market than buyers, and that's how that market works. Moving over to the CFTC COT report. This is the Commitment of Traders report, the disaggregated report put out on September 13th, 2022. It's about a week to 10 days behind the actual market. That's how the CFTC looks at it. So we will give you the week-old data on the COT report. Going down to silver, as you can see here, as of September 13th, 2022, the swap dealers were net long about 18,000, 19,000 contracts. The managed money was net short about, I want to say about 9,000 contracts. The rest of the net short was picked up by producer merchants. You can see they're short 26,000 contracts. Who is net short overall the biggest? Well, the producers are net short 19.2%, which makes sense because they have downward price risk between the time that they mine the silver and get it to market. So they take a short position to offset their downward price risk on the futures markets. If it does go down, they redeem those shorts and make the money to offset the losses that they had actually selling their physical. The swap dealers do not sell physical that I'm aware of. They could. I mean, they have it, and they could exchange it on the exchange, but they're not selling it from a mining perspective. They're selling the finalized silver, the 1,000-ounce bars. They could if they wanted to, and take the opposite side of a long contract, but they are net long. So this is the first time I've seen since 2013 where the bullion banks have gone net long in silver, and they're at a higher degree than they have been. I'll show you on a chart here in a moment, and it looks as though they expect silver price to rise. Overall, managed money dumped 11,000 short contracts last week. I think they figured out the bullion banks, so the smart money are net long, and they want to go net long. So the bullion banks reversed their overall net position between long and short, about 15,000 contracts. You can see that here to go net long. So I think the managed money has figured out to go long net silver. So I think we're closer to a rise in the price of silver than we otherwise would be. In terms of gold, it's a different story. Gold, the swap dealers are still net short by about 85,000 contracts or so. You can see here, long 88,814, short 172,633. The managed money is also net short by about 18,000 contracts. If you see the net positioning, the managed money stayed about the same over the last week, exchanging maybe about 300 contracts net short overall, and the swap dealers went net short about or net long about 4,000 contracts because they dropped 3,000 contracts and went net long 874. This is a modest move in gold. I'm not going to call a bull market in gold by watching the swap dealers and the managed money and the producer merchants on the COT report yet, although I will call it in silver. I think we're about to enter a bull market. Gold, I think, is not quite ready, at least according to the trading data from the commitment of traders from the CFTC. As we look at the bar chart, I just wanted to show you how the movements have been over time. You can see the different categories and the movements over time, and you can see that essentially in gold, the bullion banks are still net short, but they're slightly moving net long. You can see that on that line there over time, and you can see that that's been a gradual move up in gold right there. And if you look at silver, they're net long. You can see the green here. They're net long for the first time. The last time they were net long was basically back in 2013. If I go back far enough on this chart, which here we go. Let's do the 10-year chart. You can see that they were net long somewhere around the 2013 timeframe, a little bit here and here, but for the most part, they've been net short, and they finally have gone net long here. If we can zoom in a little bit to that. Let's see if we can zoom in a little bit, guys, and I'll show you what that looks like. They're net long, this green right here, but for the most part, they've been net short. So that is the market report for September 23rd, 2022. This has been your host, 𝙁𝙀𝙏𝙀𝙊𝙎. Appreciate being on with you guys. We'll do this every week to prepare you for your week ahead. Remember, go back to the beginning of the report. The first few minutes will tell you what's going on in the economy, and the last few minutes will tell you what's going on in the metals. We're going to continue to do this every week for you guys. Until next time, this is 𝙁𝙀𝙏𝙀𝙀, Gold, Silver Pros. This has been your weekly market wrap for September 23rd, 2022.